Traders at Access Bank say tariff impositions on Nigeria's exports to the U.S. has triggered increased demand for the greenback, particularly from foreign portfolio investors. They anticipate a potential intervention from the Central Bank of Nigeria to stabilize the Naira and curb further depreciation. Meanwhile, investors' appetite in the bond market is expected to remain weak following sell-offs in the 2020, 2031 and 2035 maturities. Ebube Uneze, the Treasury Team Member at Access Bank, joins me now for a market update today. Thank you so much for your time, Ebube, and I'd like to first start with what we're seeing play out with the tariffs and the impact we're seeing here in our markets.
Thank you, Kenneth, for having me. So as you rightly noted, yesterday in the foreign exchange market, the market opened on a calm note. However, with the opening of the U.S. markets midday during trading, we saw huge sell-offs by the foreign portfolio investors. Accordingly, we saw exchange rate spiral up to 1569, closing the trading day yesterday. And this as a result of the tariffs that were implemented by the Trump-led administration. It's widely noted that for Nigerian exports have been attracting 14% tariff on Nigerian exports to the U.S. As such, we are seeing most of the foreign portfolio investors reallocating their portfolio, de-risking from the emerging markets and some of the high-risk markets to safe assets and cash.
Yeah, but how do you anticipate that the central bank will respond to this if this lingers longer?
Thank you for that question. So the central bank would continue to play their role to ensure exchange rate stability. This morning we saw the central bank come into the market to intervene to sort of stabilize the outflows we are seeing in the foreign exchange market. We still expect them to continue to play this role to ensure that the exchange rate is properly anchored.
Yeah, because liquidity, judging from the first quarter, liquidity has been a key theme in the markets here today. What would you say, what impact would you say the OMO maturity has had on liquidity in the market so far? And do you expect further improvements down the line?
Thank you for that question. So the market is currently liquid. We saw the market open in a credit balance of 1.5 trillion as a result of the OMO maturity, which you rightly mentioned. So this is supporting buy sentiment from local investors. So what we are seeing is that as the FPIs are leaving, especially on the fixed income space, the local players are picking up some of these securities at very good yields. So in terms of liquidity, we see good liquidity in the market, barring any significant OMO auctions from the central bank. And this is also against the backdrop that we are expecting to receive or to see the calendar for the NTB and bond auctions from the Debt Management Office.
All right, let's get to what we see play out in the Treasury bills space. Yes, we see that we've witnessed some of those sell-offs play out here, but what would you say is driving the bearish sentiment, and how do you expect yield to trend down the line?
Thank you for that question. So the sell-offs in the bills market is largely a function of de-risking by the foreign portfolio investors. As I earlier mentioned, for the local players, we are still seeing them actively participating in that space, given the current level of system liquidity. However, with the foreign portfolio investors, what we are seeing is more of a capital outflow. So they are cutting down on their positions in markets such as Nigeria and exiting to safer asset classes.
Yeah, interesting you put it that way, because we continue to see this foreign investor activity impact the markets here. And what does this indicate about the confidence, especially from foreigners in Nigeria's fixed income market?
Thank you for that question. So foreign portfolio investors will continue to participate in our markets, provided they continue to see those attractive yields. However, given the current global sentiment, where investors are trying to reallocate their portfolios from high-risk countries such as Nigeria or the emerging markets, in the short term, we expect that we'll continue to see some of this sell-off pressure, while global investors continue to assess the position and see retaliatory tariffs from some of the developed countries. So we believe this is going to be a short-term play, while we see global economic stabilize in the short term.
Ebube, I continue to see that investors are still cautious about bonds. But in your estimation, what are some of the key concerns here that are keeping the appetite for bonds weak?
All right, thank you for that question. So given the global risk-off sentiment, investors will largely play towards the short end of the curve rather than the long end. So at this point in time, investors will rather play towards short-term bills and short-term bonds instead of going long-term on the bonds. So that is what is contributing to the sentiment we are seeing in terms of the weak appetite on the bond space.